Hi, this is Mr. Evans. This video is going to look at analysing profitability. I've actually re-recorded this video after somebody spotted a mistake in the previous one, so thank you for that. This video is going to look at gross profit, profit from operations, profit for the year, and then distinguish between profits and profitability. So I'm going to start off with that actual distinction between profits and profitability. So profit is the amount of money left over when a business has subtracted its total cost from its total revenue. That's a formula you should be very familiar with and make sure that you know off by heart by going into the exam. A really simple formula and obviously a very key one to know in business. So profit is just a number, all right? 50,000, 500 million, whatever it is. The profit is a number that is calculated by subtracting total cost from total revenue. Profitability, on the other hand, is a measure of efficiency, and specifically, it's a measure of how efficiently a business turns sales revenue into profit. So best way to demonstrate this is probably through an example. Now, we've got two businesses here, business A and business B. And this is a very simple income statement, where at the top we've got the total amount of money that the business has made in sales, that's the total revenue. Then we've got the variable costs of production that business incurred when they were making the product, i.e. if these are two bakeries, the variable costs will be things like flour, eggs, etc. They're the variable costs of production. When we subtract the total revenue, when we subtract the cost of production from the total revenue, that gives us our gross profit. But we still haven't taken off our fixed costs from that, our expenses. So once we take off our fixed costs from our gross profit, that gives us our operating profit. This is often considered to be the primary efficiency measure because this is our total revenue minus our total costs, of course, fixed costs plus variable costs and total costs. And so that gives us our operating profit. This is the bread and butter of the business. This is what we do. We make revenue from selling our products, and then we manage our costs to try and maximise our profit. But there are other expenses that may need to be taken off that, such as tax and interest payments. And when we subtract those things from our operating profit, that gives us our profit for the year. Again, it's just a number. Now, looking at these numbers, particularly the profit ones, you might start to think that business A is more successful than business B. And if you're just looking at profit, well, it certainly is. But profitability, as we said, is a measure of how efficient a business is in turning its total revenue into profit. And when we look at the total revenue that business A has made, it's much greater than the total revenue for business B. So we can begin to account for that in a minute. That's just to confirm the different profits that you need to know: gross profit, profit from operations, and profit from the year. And this is how they are calculated. Gross profit is total revenue minus variable costs, cost of production. Profit from operation, gross profit minus expenses. And profit for the year is operating profit minus any taxes or interest. So let's just consider the operating profit. And I'll go into more detail on the actual profitability ratios you need to look at in the next video. But when we start to consider how efficient each business is at turning its revenue into operating profit, then we might get a different result. Business A looks like it's made twice as much money as business B, and in raw number terms, it very much has. But when we start to consider the fact that business B only made £250,000 in sales revenue, and they managed to turn 50,000 of that into profit, business A sold much more and didn't turn as much proportionally into profit as business B did. So if you want to just pause the video and use this formula, you can begin to have a look at why business B might be more successful than business A. So when you use the formula, this is what you calculate. You calculate a percentage. Now, what this is telling us, when we divide 100,000 by 950,000 times it by 100, we get a figure of 10.5%, and it's the percentage. What percentage of this sales revenue did business A turn into profit? Well, it was 10.5%. What that means is for every pound this business earned in sales revenue, it turned 10.5 pence into operating profit. Whereas if we look at business B, when we divide 50,000 by 250,000 and multiply it by 100, we find out that they earned 20% operating profit. That means for every £1 they got in sales revenue, they turned 20 pence into profit. So this is an indication that business B is managing its costs, its total costs, far more effectively than business A. So how do we interpret ratios? Well, the higher the better. We want obviously to be turning as much of this sales revenue into profit as we possibly can. But it will depend on things like past performance, our competitors' performance, and the industry that we're in. Okay, how do we know if 10.5 or 20% even are good figures? Well, obviously business B is doing much better than business A, but how would this compare to other bakeries in the area? Are other bakeries only making 5%, in which case business B is really good and business A is doing pretty well as well. Looking at past performance as well can be an indicator of how a business is getting on. Maybe we would be a little bit more concerned about business B if last year they made 30% operating profit margin, whereas if business A was coming from 5%, then we could look at these slightly differently. But the main thing you need to take out of this video is that profits are a raw number, profitability is a percentage, and it's a measure of efficiency, how efficiently a business is turning its sales revenue into profit.